Good morning. My name is Steve Tabrizi from Remax Hallmark. I'm Chief Operating Officer with Remax Hallmark. Welcome to another episode of Remax Hallmark Marketing Report. It's a beautiful Wednesday morning from city of Toronto, and I'm sure everybody's anxious about this episode, considering what's happening in our market. And I have a very special guest that I religiously follow within the market. Derek Burleton is Vice President and Deputy Chief Economist of the TD Bank Group. Derek leads a group of economists on a daily basis that they research, they gather information, and they present multiple tiers of the reports with respect to ongoing economy in Canada and in Ontario and other provinces. Derek has been quoted by many media outlets, including the London Financial Times and Economist. One thing that really attracted me to Derek is his passion for public policies, including sustainability, including healthcare and immigration, that mostly are related to the real estate sector. Derek also received a bachelor degree of commerce from the Queen University and also an economic degree from the London School of the Economic. Without further ado, it's my pleasure to introduce Derek Burleton from the TD Bank. Good morning, Derek.
Good morning, Steve. Great to be here.
Thank you very much, first of all, for accepting our invitation in short notice. I know you have a busy schedule, and I'm sure these days your schedule is probably full pack because perhaps every day we wake up and we see new changes within our economy and within what's happening in our country and in our city. So we have a great group of real estate practitioner consumers today that are watching our interview with you. And before we start, I'd like to set basically how we're going to conduct this for our audience. Derek and I will go through a series of a discussion for the next 25 to 35 minutes, and then we will allow about 10, 15 minutes for QA. I'm sure sometimes these QA may drag more than the 10, 15 minutes. We try to limit them considering the time for everyone, particularly Derek's time. Shant, our marketing coordinator, he will basically read all the questions for both of us, and we will try to answer to the best of our abilities. So, Derek, let's start by your overall view of the global and the Canadian economy, particularly in the last few weeks, considering the parity of the euro and the US dollar, and also perhaps the ease of the COVID in China, and your views with respect to the impact of the parity, plus also your views in terms of the China's supply chain.
Yeah, I mean, it's been an interesting year, you mentioned, and in a few minutes we'll hear from the Bank of Canada in terms of what it has in store. If you got insomnia, they'll be putting out their updated, fairly in-depth forecast for the economy. And, you know, I tend to look at that because obviously it's important for reading the tea leaves on where interest rates are going, but they have so much data at their fingertips on inflation and all that. So a bit of a plug to the Bank of Canada's forecast will be out momentarily. But to go back to the world where I see it, I was heartened heading into the year, Steve. I thought, you know, things were playing out as we had thought. You know, I think at the best of times, the global economy was going to downshift. You know, a lot of the recovery from COVID was behind us. You know, China had shown some signs of softness with its decline in its property market, some of the measures of the government to contain things. But for the most part, labor markets were strong in major industrialized economies. The thing I was looking at come late fall was some easing in supply chains, because we know that had been a source of higher inflation. That was beginning to turn, and it's been a game of whack-a-mole, effectively, where every time we think we're over the hump, we get hit by another, what we call a shock. In this case, it was the Russian-Ukraine conflict that drove up commodity prices to a new plateau, just created a new wave of inflation, sand in the wheels of global supply chains. And what we've been running ever since is just surprise after surprise of higher inflation, not just in the US, but in Europe and have you. So what we've been doing is steadily shifting our growth forecast for the world, particularly for 2023. I think next year is going to be more of a question mark as central banks catch up by raising interest rates to try and prevent inflation from becoming too entrenched. So, so that's where we are. We're now looking at an outlook for the world that I would consider stall speed going forward. It's going to be positive. And some of the latest indicators we've been looking at, purchasing managers indices from Europe, still shows a slight bit of expansion as we move through the early summer. I think the question is what we see going forward. And it's not going to get any better. I worry about Europe. I worry about Russia potentially shutting off more natural gas supplies, creating, a deeper recession in Europe than, say, the dynamics would suggest here. The U.S. Gets a bit of a bad rap, Steve, because it's had some weakness so far this year. Its GDP have been declining, and in the second quarter, it may be close to zero. But if you look at the job market, it's sending a very other opposite signal. Data last week suggests jobs are still growing rapidly in the U.S. Unemployment is still low. So I think that's important because we tend to rely on the cushion of a strong job market to get us over the hump. And in the U.S., we still see an outlook for very slight growth, but still positive. I think the bet we get a recession in the U.S. is about 50-50 right now. But I think what's a very important point is not all recessions are created equally. You can have a couple of, a number of weak quarters, but if your unemployment rate only goes up 0.5 percentage points from these very low levels, we're not going to feel it all that much, particularly in the US, but here in Canada. If we get something deeper, it's a different story. And what I take heart of is the fact that the US household is still financially in good shape. Its debt levels are still low. And you're not looking at a kind of a consumer-led recession. The US would be more business driven, and they tend to be more light in terms of downturns. So that's something we're going to be monitoring. Canada has just done very well so far this year. The growth we're tracking in the first half of 2022 is strong. That's even with the headwinds on the consumer from high inflation, high gas prices. Still a fairly hefty amount of excess savings are helping the consumer pay for a lot of more expensive goods. The growth is not sustainable. We know that. And the Bank of Canada is very aggressively raising rates to ensure inflation begins to pull back. And we do see that happening, by the way. But, again, I see some good cushion there with a job market that's strong. Unemployment, which if you adjust for measurement differences, is actually lower than the United States right now. Wage growth is picking up, albeit that hurts business margins, but good for households. And commodity prices actually deliver a bit of a tailwind to growth in a number of regions of Canada and through federal coffers. So I think when you add it up, we should be okay here in Canada. We're going to see some growth, but this kind of growth we've seen of late is not sustainable.
Interesting how when I met you about 4 weeks ago, you were concerned about that the Bank of Canada rapid rising the interest rate may not pull the inflation back, but now you just mentioned that you are noticing the inflation is pulling back. So on your day-to-day, your team related to the real estate sector, what sort of numbers or what sort of factors that you guys track to give you a better indication of, particularly with respect to the real estate market?
Yeah, and to go to that point about inflation, it's not, we're going to get the June data next week. It's going to be another big lurch higher in inflation in the month of June. We know that because gas prices soared. What we've seen more recently, though, is gas prices have pulled back a bit. Part of it is, because of tax cuts, temporary relief from governments on gas prices. But we have seen supply chains beginning to soften a bit for goods. Disruptions, again, we go back to that early fall. We're starting to see that happen the other way. We know a number of commodity prices have fallen, things like lumber, which go into new construction. That's been falling quite significantly down. A lot of commodities are down 20-25% from their peak. So now the focus, Steve, is on not so much stagflation environment. It's more on what's the risk of recession. That tends to pull back some of the prices and some of these key commodities and the like. I do think we're going to see a cresting of inflation this fall, but it's still going to be high. I mean, you're not going to get a lurch down to 2% anytime soon. That'll be more of a story as we move through 2023. We'll begin to see further convergence. Still going to be elevated, but I think we're going to see it move in the right direction, even as interest rates move higher. In terms of the housing market, we're obviously we have our, going through all the data, parsing all the data right now. The rate story is key because with each interest rate hike, we've got to build that into our model on affordability. No matter how you cut it, it's going to mean lower home sales. We've already seen certainly sales activity pull back quite a bit and pricing beginning to pull back, particularly in the GTA region. That's going to continue. Our best bet, mirroring that with our view on interest rates, and we do see a peak of about 3.25% in short rates. 5-year rates won't go up too much higher, just given that they tend to be more aligned with the outlook for inflation and the like. They've built in a lot of the rate increases. So we see short rates coming up more than longer rates, but that's going to lead to further curtailment. I think by the early 2023, we're going to start to see some of these declines ebb. And other things I'm going to be looking at to justify that view would be sales to listings ratio in the housing market. Right now we're kind of in that balanced territory. We're going to move into a buyer's market very soon. But how low that gets, I think we're counting on supply to remain fairly contained to kind of mitigate the downside. Job market, of course, is key. We see unemployment rate rise from these lows, but if it only goes up 0.75 of a point, I think we'll be okay. That's still a healthy job market, and that'll be a cushion. I think in terms of just general housing data, we're going to parse it all. But I think if we're okay now, you're hearing all these numbers of a big decline in home prices. I think we've been on record as saying prices are going to decline 20% before it's said and done. CMHC came out with a view earlier this week that had a very mild decline in prices. I'm comfortable with our view, but keep in mind that 20% decline only takes back albeit a big chunk of the run-up we've seen during the pandemic. Doesn't take you back to 1995 levels or anything like that. So I see this as being a healthy recalibration in the market. Again, accounting on these, certainly relying on some of these factors to support the downside. And one I forgot to mention was population. I'm going to keep my eye on the quarterly population estimates. Actually, we get monthly data out of the Labor Force Survey. We're continuing to get a lot of people flocking to Canada, new migrants. They're going to have to find housing. So that's another, so some of this is just cyclical, bottom line. But I'm okay. I'm not losing a lot of sleep. The one thing that, I think we need to be mindful of, and I'm going to be watching, is feedback from a declining housing market to the broader economy. If we start to see employment and construction falling rapidly, then you could be in a more negative type scenario. But I think these are some of the things I'm going to be watching to kind of ensure that our forecast remains on track.
Great. So there is a sort of a disagreement among the economists that I've been reading or watching for the last probably several months. I mean, pandemic started in March of the 2020. Of course, the federal government didn't have no other choice or alternative to issue stimulus packages and quantitative ease to make sure that the economy doesn't collapse. And then they lower basically the interest rate. Literally in our industry, we called it the money was free. So there is an argument out there that perhaps maybe the Bank of Canada should have started raising the interest rate in 2021 when the economy was recovered nicely, when the unemployment rate was pretty much decent, sitting at anywhere around 5.5 points. How do you feel about that? Do you think the Bank of Canada should have entered to the rising the interest rate earlier to combat this unnecessary, basically drastic rate hike, which really surprised the consumers this year and caught them really off guard?
Yeah, and to that point, I mean, if you look at the speed of adjustment in interest rates, it was only how many months ago rates were still at zero, and now we're looking after today with likely a 75 basis point rate hike. You're getting to 2.25. I mean, that's a very big change overnight on the short end, and a lot of variable rate borrowers and floating rate borrowers out there. It's been astonishing the speed, and to your point, I think they should have. Hindsight is 2020. I mean, we can look back. Some forecasters, and we had maybe a little bit earlier as well, said, maybe it's something they should think about doing, getting rates up earlier. But I'm a bit sympathetic to the Bank of Canada. I think, they underpredicted inflation, but so did we. So did Bay Street in general. Nobody expected this kind of, we saw obviously some of the crude oil prices rising, risk of pass through to broader consumer prices. That was building. But this game of whack-a-mole, we didn't forecast the Russian-Ukraine war that just kept the whole thing going. So I am sympathetic. So it's 2020 hindsight, but yeah, I think there's broad consensus that central banks, not just in Canada, the Fed and in Europe, should have started this process earlier. I think in Canada, what hasn't helped the Bank of Canada is the fact that the governments have continued to spend this year. You sort of look at stimulus as being a two-pronged. During the pandemic, you had a lot of government spending supports to help those that have been dislocated because of the pandemic, businesses and the like. That was all very legitimate, but they did keep the well open longer than maybe they should have. Budget season this year still featured a lot of new spending, albeit it's still, the growth is down from its peak, but they're still growing their spending at a fairly healthy rate, federally and provincially. What that does is just adds more stimulus to an economy that's already, in a sense, at full employment or even higher than full employment. It's a very strong economy and just adds more pressure to the Bank of Canada to raise rates even higher to ensure inflation falls, down below 3% over the medium term. So all that to say that, yeah, I think 2020 hindsight, they waited too late. And now with inflation expectations becoming more entrenched, and we'll hear a lot about that today by the Bank of Canada, this is why they're having to raise rates even quicker and to a higher level than many had thought. We still think 3.25 is going to be the peak, and that's going to hit the fall, and then they're just going to ride it out there for at least a year. But there's still risk brewing that it could be even higher than that at the end of the day.
I guess Canadian, they got caught in the election year because so many promises by federal and provincial. And I guess, as you said, they are keep spending on the stimulus packages, which I do agree with you. We really are at the stage of the economy that we don't need any more of those stimulus packages. It's actually causing, particularly in the labor market, issues for businesses, including our business. Canada historically has always been a country that basically the ratio of the home ownership to rental has been much more higher. 2/3 of the Canadian are homeowners and 1/3 are renting. Is it a fair statement that we, particularly in GTA, we reach a point that we have to really accept that being a rental for a certain period of the time is going to be okay? Because what we see, all the numbers and the data, even with the rising the interest rate, we as a practitioner, we feel that it's going to be a short period of the time that basically the market be maybe in a balanced market, but soon we will be back again in the rising market, maybe not as rapid as the first quarter of the 2021. How do you feel about the change of the landscape of the home ownership versus rental?
Yeah, and just to your point, I do see, that's one thing we know, that we will see a recovery after we hit a certain point. You can debate about whether that's a 30% or 35% decline in sales. I've given you the price view, a 20% peak to trough decline in prices through the early part of next year. Is that going to be it? Or are we dealing with something deeper, perhaps even shallow? I mean, some of the other forecasts would suggest that we're on the more conservative end, if I can put it that way. But yeah, I think recovery will be quite muted in the home ownership market, I think, because if you look at any affordability chart, it's still going to be very stretched. You're going to see some of that unwind. I mean, interest rates rise as a negative for affordability, but as prices come down, that works in the opposite direction. But it's still going to be a very unaffordable market for the average, Ontarian or Canadian. So, rental. The pendulum is going to swing in favor of rental. It's not exactly a very affordable rental market either, but still more affordable than with all the home ownership costs involved, buying a condo with maintenance fees and the like. I can see the pendulum continue to swing. I mean, if our job market forecast is right, you're still going to have, and you got people flowing to the region, there's still going to be a lot of, people forming homes. And if the rental market is a place they're going to flock to in bigger numbers, that market is really just going to get stronger. And you're going to be hearing more about home ownership, affordability issues, but maybe more from a rental standpoint. It's all been about helping affordability for home buyers. I think the government lurch is going to get back to how do we make rental more affordable. And that's going to be a big policy shift. But yeah, I can see that happening. It's again, the rents are just going to go up, and that's one inflationary impulse. I don't think that's going to wane as we see goods prices beginning to pull back from these very high levels, used car prices and the like. If the demand is going to wane, rent is one service that is going to continue to gain strength in the month ahead. And I think it'll be interesting because investors have been a big part of the market in terms of purchases. We know investors of all types, and the economics has been challenging of late, especially if prices dissipate. But if if the rents go up, that obviously helps to provide an offset on the economics of investing and renting. So we'll see. I think the home ownership rate is going to come down moderate. It's going to remain relatively high, but there's one direction for it to go from these levels, I think.
You just touched point about the affordability. We see the rise of the interest rate. We see in our industry the number of the transaction in comparison to the first quarter of this year has dropped by 20, 30, 40%, depend which part of the market center you are. But we haven't noticed in comparison to 2021 any drop in the prices. We actually have seen a single digit increase compared to 2021. Yes, of course, we have seen the drop in comparison to the first quarter of 2022. And Bank of Canada and Feds on the south of the border, they talk about balancing the basically supply and the demand. I think the only measure they have, rising the interest rate, remove a percentage of the group of the people from the demand portion. So therefore, hopefully the inflation will drop. Well, we haven't noticed anything in terms of the drop of the inflation rate in a direct correlation to the real estate market. Do you think the continuation of the increase of only interest rate and hurting the real estate market would really impact on a drop of the inflation rate, or no, we are basically in an era which is not a really normal economic historical data. We are in the era that basically we are caught by the supply chain, energy costs, and the combination of the multiple factors that perhaps even Bank of Canada or Feds on the south of the border, they really don't know what they have to do.
Yeah, I mean, its stickiness has really been the watchword, the stickiness of prices. It's interesting that, if you look at the consumer price basket, 30% is shelter. And of that, about 2/3 of it's owner accommodation. 1/3 would be rent. Giving you a bit of a view on rents, they will continue to accelerate, albeit there are rent regulations in place that may mitigate, but you still will see that measure continue to accelerate. So that's going to work against what they're trying to achieve, which is price stability or a very modest rate of growth in overall consumer prices. The one area of relief I think that's important would be owner replacement costs, and that is really a benchmark of new home price. And we have seen lumber begin to fall. I realize that there still are a number of areas of pressure that builders are facing, but at least you're beginning to see some of the early stage commodities begin to pull back. Labor is going to be one that you won't see as much pull back, but that's probably going to continue to gain strength. But that would be one important area of the shelter component that I think will moderate quite a bit. And then you're dealing with a lot of other costs, insurance, utility costs. Utilities, I think, hopefully will moderate at least some of the energy prices. So it's really a mixed basket. And I think when you net it out, it's going to be very sticky to come down. I think if they're looking at areas of the CPI, they're going to moderate. They're outside of shelter. They are, and that's 1/3 of it, unfortunately. But it's I mentioned gasoline prices are pulling back already. Food costs should begin to fall. We're seeing early stage commodities begin to pull back. So but we've been wrong, and we saw the U.S. CPI data today, another big upside surprise. So if one's conservative in their forecasting, they're going to lean to say things may be even more sticky than even the central bank wants or forecast, and that could be even higher rates. So the 3.25 we forecast, if you want to run other scenarios, it may be as high as 3.50 350, 375 at a peak. I don't think it'll be 5 at the short end. And that's where I see the balance of risk for in the near term. Now, going out, of course, if you're in a weaker economic environment, you could see rates beginning to pull back, but it's because the job market is weaker and the like. So that's more of a near-term versus medium-term risk scenario that I would bank on.
Talking about continuation about the affordability, CMHC a few weeks ago came up with the report, shocked provincial and federal government in terms of the number of the housing. Mr. Ford estimated that he needs about 1.5 million homes over the course of the next 10 years. Our industry has been managing only about 80,000 homes on an annual basis, which is about 800,000. Now CMHC came up with 2 really surprising reports. One a few weeks ago, one actually a couple of days ago, as you alluded to it, estimating Canada needs about 3.5 million homes, and 2/3 of it are concentrated in Ontario and BC. Ontario, basically, they estimated almost about 1.9 million homes. And also, a couple of days ago, report CMHC alluded that they see this as a short sort of a stagnation of the market, and they see by late 2024, early 2025, we see the rise of the prices. So considering the rise of the interest rate, which increased the cost of the borrowing for businesses, for construction, shortage of the labor that everybody is talking about it. And now there is a rumor in our industry that many developers that they have pre-sold some pre-construction condominium, because of the rising costs, they may cancel the project. So we are actually taking away the inventory from future forecasts. How do you see that we can combat this supply and demand issue? I personally feel that in maybe another 15 months or 24 months, we'll be back to square one, and we will be talking about the same issue of the supply and demand.
We could very well. And I think part of it is just the timing of that release by CMHC, because the numbers are mind-boggling. They talk about having to build 3.5 million more homes across Canada. You mentioned disproportionate share in this region and in Ontario. Those are huge numbers. And that's in addition to the business as usual levels of I think 2 million over 10 years. So that assumes starts of running kind of more at a status quo pace. That's 5.5 million homes over 10 years. And that's 550,000 starts a year, say. And that's so much stronger. The building levels at 300,000 have been multi-decade highs. We haven't seen this building boom since the 80s. And yet this only scratches the surface in terms of what the agency sees we need to build to equilibrate the market. Now, I think what's important when you look at the details of that, what they're trying to work out is what they feel, given a certain amount of household formation, demand, new population, and all that, what would be required in new supply versus demand to get pricing and affordability back to where it was in 2003-04. And I was trying to read and find out why they chose 2003-04. It's such a long time ago. I mean, it's a very ambitious thing to get. So what it would imply, Steve, is getting pricing down to improve the affordability equation to get you back to something that was 2 decades ago. So I think the point of their report is not so much these numbers are all that realistic. This is very aspirational. I think, how do you create that much? We'd have to have everybody leave their banking jobs and go to construction sites to do that. I think it's more just, here's an illustration. The point being, whether we're too high on these numbers, we need more housing supply. Now let's get to the core issue, which is influencing public policy to ensure more flow of supply, a more versatile market, a more market that's more responsive to the demand of home buyers. And I think that's a key valuable point, because I believe 100%, even if we see demand pulling back even more than some of our forecasts in the next couple of years, longer term, we still have a big issue. We will come back to it, and we need to get on that. And, the federal government is working on it with the provinces. I think they've identified. Now let's get on to the business of looking at regulatory. There's a lot of good programs in place to help first-time buyers, and on supply in terms of building more affordable supply. Now let's get on to the job of actually seeing a lot of these through. But I think a lot of it still needs to be done. Provinces, until you begin to get rid of NIMBYism and all that, you're not at the heart of it. So a lot of work to do. But yeah, the numbers were astonishing. Yeah, I think part of it was just the timing of the release at a time when the market is weakening and we're worried about excess supply in the near term.
As you said, it's a beautiful report, but is it doable or is not doable? Frankly, I personally think it's not doable unless we have policies and a roadmap for the next 25 years without influence of any ruling party that being placed in federal or provincial. We can talk about that for, I'm sure, for hours. Labor market. Labor market has been probably one of the biggest challenges for businesses across Ontario, particularly because it's a hub of the engine of the economy of Canada. It's hurting many businesses. Wages, labor force keep increasing, and the businesses, it's actually working in contrary. We want to bring the inflation down, but because the wages are increasing, so the cost of the goods are also increasing. And now we are facing also the Americans are job hunting other talents in Canada. How do you see we can combat this labor force market? And do you foresee that the labor force market influences that right now exist could hurt the business growth in Canada overall or in Ontario?
Yeah, I just saw the breaking news of a 100 basis point rate hike by the Bank of Canada. So there's another forecast that we made that went astray.
Wow.
Yeah, it's an unusual time. I still don't think, Steve, that's going to affect our view on where we're headed around the 3.25 point. I think they just want to front end load it to ensure that inflation expectations, looking out, consumers' view of where prices are going, don't become too out of whack. So I saw Shan posted that. But all that to say on the labor market, yeah, it's a huge challenge. I think part of the stickiness of inflation is due to wages that are accelerating. And we're now beginning to see wage numbers really perk up on a year-over-year basis. In Canada, we used to have 3.5% was kind of the trend. It's now up around 6%. And it probably will move even higher. And this is why any real break in inflation won't happen until the second half of 2023 in terms of getting it down to a more normal level. But rate hikes will certainly help. But the job market, you're getting into some of these longer term issues of mismatch in skills. We have a more mobile workforce now with home working and the like. That helps employers a bit, gives them a bit more flexibility, so they too can go to the United States and attract both ways. At the end of the day, I can see a much slower growth in the economy, freeing up a bit of slack in the job market. That'll help a bit. At the same time, one of the reasons we don't have unemployment rates rising substantially in our forecast is I don't think employers are going to want to get rid of labor very easily. They're going to wait until it's really necessary. So you're not going to see a lot of layoffs in this kind of environment. And that helps that's the glue that kind of keeps our forecast together. But mismatch is that million-year-long public policy issue where we always face a high-level mismatch. It just becomes more evident when the job market is so strong as it is now. Robots, automation is helping to deal with some of the challenges because we've seen a lot of the workforce move away from these areas that were so hard hit during the pandemic. The leisure, hospitality, restaurants, people have flocked to a lot of different occupations, whether it be an office type job, self-employed, that kind of thing. And that's permanent nature. I can see a lot of those people not flocking back anytime soon. But I think businesses are being forced to come up with new creative ways to deal with demand with fewer workers. This is something that I see dragging out. I think, though, it comes back down to this, matching up the skills with this kind of new economy where, you all be working more with computers and machines and automation. And that's really the job, an ongoing task at universities, colleges, to come up with the right programs in which to match on a longer term basis. So some of this is cyclical versus longer term and structural. But yeah, it's an age old question. I do see some relief, though, coming with higher unemployment, because part of this is just an unemployment rate that is unsustainably low right now in Canada.
Well, we just saw the Bank of Canada's announcement surprise everybody from instead of even 0.75, 100 basis, it completely went up. So it brings me to this question. Perhaps you can share with the audience the neutral zone of the interest rate. There has been discussion all over the media between two, some people call it between 2.5 to 3.5. It's a neutral zone. It's a zone that basically, hopefully there is no growth. There is a moderation of the inflations. So where do you see the Bank of Canada is going to push the limit? I guess today they basically said, why not? Let's just go all the way. So we don't have to basically drag through this media every few weeks about what we're going to do. And frankly, to be honest with you, I like that move because you take the bandage out once rather than just, piece by piece. So how do you see, what do you think they're going to push the limits? And if they really, you talk last time when I was at your presentation, you were concerned if they pass a certain limit of the neutral zone, then they actually may cause a slight recession or maybe a short-term recession.
Yeah, and that probability keeps going up with each rate hike. Their latest estimates, it's around 2.5 to 3.5. They've kind of oscillated a bit. 2 to 3 was sort of where they saw as the neutral zone in their last communication. We'll see if they've amended that at all today in their communication. So that's one thing I'll be looking for. It's in the eyes of the beholder. We at TD Economics have a view that it's probably at the lower end of that range. So hence, and there are reasons, structural reasons behind that. It's an aging population. It's a slowing, structural growth rate in the economy that leave it lower. So I would say it's probably closer to 2, which means our 3.25 peak in rates is what I would consider to be reasonably restrictive and will lead to the outcomes that ultimately they're trying to achieve. They may very well provoke a recession. It's not something that'll happen in the next quarter or two, probably in the first half of 2023 if it were to happen. And again, it's not a big difference whether we have very slight growth in our forecast or a mild recession. Mentioned at the outset, it's going to feel the same way to Canadians. I think it's not too different. What you don't want is that kind of situation where you have a negative feedback loop. Remember the great financial crisis? Of course you do. Everybody does. In the United States, that was that kind of very negative feedback loop that led to an economy that was weak for years. And in Canada, we're trying to avoid that. And I think we will. I think with stress testing, some of the regulatory measures, strong banks, a lot of good regulation has mitigated the risk of that kind of crisis forming. And I'm not losing too much sleep at the moment because of that, but a mild recession could very well happen. I think it's an even odd 50-50 odds kind of thing, whether we have one in, say, the first half of next year or a very mild growth scenario. But restrictive, I think we're going to get to, Steve, by the late summer, early autumn, I think, over the next few meetings. One thing I'll be interested to look for today as well is signaling about future rate hikes. They may just signal that they're doing a lot of the heavy lifting up front, which may lead the market to kind of peel back the amount of tightening they see going forward, how many more rate hikes. So I'll be keeping an eye on market pricing and forward guidance from today's statement. I think that'll be key.
Do you foresee that instead of a recession, it's more sort of stagflation or maybe a resiliency of the Canadian market?
Yeah, I do think there's a resiliency of the Canadian economy. I mentioned the growth momentum we've had in Canada. It's been resilient. We saw resilience right through COVID and the pandemic. I think some of the early impacts really did wane. We had very severe impacts in 2020, and with each passing wave, the measured impacts on the economy and job market got less as we adopted as an economy. So I think that's important. I do see a resilience there. But yeah, I think it's certainly going to be tough sledding, I think, at the very least. And so it'll be interesting to see. I think Shant just flashed another message. I wonder if it was probably from the Bank of Canada statement. He's doing a great job kind of sprinkling some of the highlights of it. But, I do think that, stagflation, I have to say, worries of that have dialed back a bit. I think now it's more about, are we going to have a recession, which means markets are peeling back the amount of inflation they're pricing in on a 2 or 3 year basis, and more about, okay, how weak will the economy and economic activity get? And that seems to be that's why commodity prices have fallen. That's really the big question now. It's less about, are we going to have 8% inflation a year from now? I think very few people and market participants think that now. So if we have stagflation in here and now, it's not likely in a year's time.
Good. So my last question from you. So particularly direct relation to real estate market. What's your sort of a forecast? What do you see, and how would you recommend to practitioners or buyers or sellers in this industry they should navigate this market?
Yeah, it's I guess I'll just echo maybe a few things I've been saying. I mean, it's a tough market to navigate. I think in part because right now, until we get to the fall market, it's going to be hard to know how much the recent decline in sales is due to a pull forward to get ahead of rates, how much of it's due to just shifting psychology going forward. So until we get more data around investor activity and the like, I think by the fall market, we'll get a better sense as to, whether we're on track with sort of our view of a sort of a 1 year long pullback followed by some stabilization in the second half of next year. I think just echoing an earlier point that, this isn't unlikely to be a multi-year thing. I think that, I look at a lot of still very positive long-term fundamentals. We will see recovery, even if it's quite muted. So to ride out the storm, but be open-minded that, nothing in this environment is a slam dunk. The regional side, I think, is key. I painted the market with one brush. We know that the GTA, Ontario, the various markets, is going to be a lot of varied performances. In general, the rule of thumb is markets that saw the biggest lurches upward are going to see the biggest moderation, just because you've seen such a big erosion in affordability, and it's really ranged. I'm thinking the exurbs of the GTA region, suburbs, they'll probably moderate more over the next year or so. But it's going to be, and then it come down to different unit types and the like. Some, single is one area where I remain quite optimistic from a longer term basis. I do see the value of real estate, of land, over the 5 to 10 year horizon for some of the reasons we've talked about being quite strong. So I would again advise about, and I don't think this is going to be too shocking, but I think just that one can't paint. We're going to see a lot of varied performances over the next year in terms of segment type, regions, and there will be a lot of opportunities, I think. So those are just a couple of things. And I think the other thing would just be, think about your scenarios. I think forecasters are kind of signaling a bit of false precision where they think rates will peak out. I mean, we just saw today as an example, I thought it was 75. That was kind of the signaling, and they leapt over that one just needs to have a few different scenarios on rates. They may not peak out as early as we think. I'm more worried right now, just given that they are so adamant to get inflation down and how sticky it is, that rates may have to go a little higher than we expect in the next few quarters to achieve their ultimate end. But at the end of the day, there will be a limit because the economy will weaken. There is going to be a cost in terms of foregone jobs and economic activity and housing activity for sure. So just a few different things and navigating what is a very challenging market, no doubt.
Well, to sum it up, you really gave it a beautiful picture. Unemployment rate is low, immigration are flocking Canada. Businesses are obviously affording and expanding because they are dealing with the wage hike. And I do agree with you. I think they just have one mandate. They are really the mandate. They want to bring and stabilize the inflation. Even as Shant just posted, gave us some latest news, the gas price is going down by another 8 cents. I do agree with you. I think it's going to be a short term, probably by fall market, which the similar prediction that we have, we probably reached what we call it the landing point, the bottom line, and we'll figure out what's going to happen after that. I want to thank you first. Great insight from your views with your team. And Shant, we are open to some questions. So go ahead.
Thank you very much, gentlemen. That was honestly very informative. And we have some questions at the moment. Let me see. I had one here from Cameron Levitt, who's one of our real estate agents here in Toronto. The question is for Derek. Do you think that yield curve inversion is less of a necessary signal these days compared to pre-GFC because of so much intervention by central banks in the bond market?
Yeah, it's an excellent question. And that is always our caveat. We still look at inversion as being a leading signal for recession. Again, it doesn't tell you how severe that recession is going to be. It's just that the market is pricing in ultimately rate cuts because of weakness. And that's what tends to drive inversion. It tends to weaken the longer end, brings those yields below the short-term yields. So I still think it's a leading indicator. But quantitative easing previously and now tightening, I think, has maybe potentially distorted some of those signals. And so, we use it as one potential indicator. I look at other things. I look at hard data, soft data, purchasing managers indices, some of the, forward-looking expectations from sentiment surveys and the like. I look at a whole array of things. So I don't just put all my eggs in this inversion basket. We have seen mild inversion of the yield curve, and that's, to me, consistent with more the direction of the economy, that it's going to slow down more aggressively than we would have thought 6 months ago. Maybe a slight recession, as mentioned, but it's a 6 month to 2 year indicator, so leading indicator. So it doesn't tell you imminently, it gives you a good amount of forewarning on it. So I'm going to continue to track it. If you have a sustained inversion, it just increases the risk further of a recession. And right now, I would put that odds already at a fairly high 50-50 probability.
Thank you, Shant.
Thank you very much for that, Derek. I have a question here again for Derek from Odris Coco, who's one of our other realtors. It says, hi, Derek. Do you see the probability of rate increases taking a toll on the economy and consumer spending, resulting in Bank of Canada start reducing the rates back in the near future?
Yeah, I mean, I don't think inflation would have to fall dramatically. Really, their primary target is inflation. They're not as focused as they traditionally are on economic performance. They really want to see that inflation rate coming down quite a bit. I know Steve mentioned gas prices have really come down. That's really going to help the inflation numbers when we get the July figures. And if that keeps going down, that's going to be a big step forward, but it's still not the only step. You got wage pressures, you've got rent pressures. So I would say that, the rate cuts, if they do happen, probably would be at the earliest second half of 2023, maybe into 2024. I know market pricing has pulled forward the likelihood of rate cuts, just given higher recession odds, to the tail end of next year. So we'll keep our eyes on market pricing there. But yeah, at the end of the day, it all depends on inflation. That's really the primary driver, and to some extent, labor markets at the end of the day. That will drive it. But it's not something, don't count on a rate cut this year. It just seems highly unlikely at this stage, unless the one risk would be, say, for example, this is hypothetical, say we had another big financial shock globally that really is getting a lot of people, including central banks, worried. That could happen very quickly and abruptly, change the outlook very quickly, and change the inflation outlook very quickly. So that would be the one slight risk. But of course, I don't think that's likely. I'm certainly hoping it is, that's for sure.
Thank you very much for that. I got another question. I think it's for Derek again. It's from Team Mascarian. Question is, what do you think about unemployment rate in the future soon?
Yeah, we've actually run two scenarios. One of them is our traditional baseline scenario we do on a quarterly basis, and that had unemployment in Canada rising to, I think, about 6.2%. It's now, well, we saw it plunged to 4.9 in the latest survey. I do think that's some volatility in the data. We'll probably see it pop back up more to kind of the low first half of the fives, 5 to 5.5 in the next month, just as we get a bit of a rebound in the labor force. That's short-term volatility. So say trend is around 5. We see it rising up over 6 over the next 3 to 4 quarters as employment gains slow significantly as the economic growth picture softens. We've run a second scenario, which is what we call a recessionary scenario. So that we made public in a perspective by my boss, the chief economist, last week. It's on our website if you want to have a look at it. All we're saying there, what if we're wrong, and the economy were to fall into recession, what would be kind of a contour? What would that look like? And it's pretty mild, and it's not that different from our baseline, but that would have an unemployment rate rising to kind of 6.6, I think. So not two different pictures, but it gives you a sense of the reasonable range, we think. So that's where, and that'll be over the next year so that we'd see that kind of movement. It's still fairly low. I mean, you don't have to go back that far to see rates higher than that in a general expansionary time. So it's not something that I think is going to be too much stress on the economy or job market and housing market as well.
Amazing. I have two more questions. This one is actually mostly for Steve, I believe. It's from Masood. Question from homeowners I get. He said, should we sell our homes today to avoid losing it to the bank, or should we sell our primary home so we can buy it cheaper next year?
Well, I think this is a very broad question. I think every individual has a different financial abilities and conditions. So my recommendation to you would be, I firmly believe when you sell low, you buy low. When you sell high, you buy high too. There is no such a thing that you sell high and you buy low. And it's always been consistent for the last 10, 15 years. My recommendation to you, Masood, is talk to your seller what their condition. And as Derek suggested, you can sell now, but there is no guarantee that 6 months or a year from now, the prices will be lower or will be higher. One thing I really need our audience to pay attention, the inflation is because of the excessive of the demands. Demands, that means the consumers, they're spending money. They have money in their saving, they have money in their pockets. So it's not, as Derek said, an economic correction of the 2008 and a meltdown. Economy around the globe is healthy. The demand is at peak for goods, for everything. So it's just basically a temporary measure. It could be last for a year, 15 months to really lower the inflation. And considering also the supply goods that unfortunately global market is really tied to the Chinese market, and also the energy cost. So the fundamentals are there. If the fundamentals ever are not there, you have to pay attention to the fundamental. Then maybe, yes, you sell and you go rent for a while, but the fundamental are there. So I wouldn't really panic and worry about it. I make a sound decision.
I have a question through Facebook from Bobby Alejandro. It's for either Steve or Derek. Which industries will be more resilient compared to others during this time? Real estate, food industry, etc.
Derek,
Yeah, I think in general, the rule of thumb would be as interest rates rise, the most rate sensitive sectors are going to underperform. That would be not just residential real estate, commercial real estate. The office market is, of course, dealing with a few different challenges there. It's dealing with the impact of the pandemic, different work from home models, and now inflation, higher rates, and obviously it's a rate sensitive sector. So real estate is going to underperform. Some of the areas we're counting on, we still see okay performances in areas like manufacturing. A lot of that would depend on the type of goods, of course. If you're a manufacturer of interest rate sensitive goods, those are going to cool. But autos is one that's an important good. But because of the chip shortages, that's delayed some of the growth. So I'm wondering, that could be an area that actually could strengthen even though interest rates are rising. So we're dealing with a very strange set of dynamics there. Still looking at decent performances across a lot of services. I think, there still is pent up demand for a lot of different services as we've come out of the worst of the pandemic. I know it's not maybe completely gone yet as we had hoped, but you're still going to get recovery. Service activity is still well below where it should have been without a pandemic, whereas goods spending is above. So I think there's still a lot of the service industries are still going to benefit from just that pent up demand recovery that we still see happening.
Thank you for that answer, Derek. We have one last question before we wrap up. This one comes from Desmond Brown. It's either to Steve or Derek, but I'm guessing it's mostly for Steve. It says, while listing properties today for value with prices falling, what period in the recent past do you suggest we pull our comps?
Well, we monitor the comparison of the prices year over year, Desmond. And as I have mentioned many times, I really don't like the comparison of the 1 month over 1 month. And unfortunately, the media is not doing a justice to correction of the prices. The media keep comparing the prices to the first quarter of the 2022. Right now, the prices are sort of demonstrating the comparison anywhere between the September to November of the 2021. That's why you see when there is a comparison of the year over year or 12-month cycle, which is the proper statistical approach, you see anywhere between 7 to 13% increase on the prices in 2022 versus 2021. So at the moment, it's sitting anywhere between September to October. I suspect with this latest increase of the interest rate and perhaps with the continuation of the little bit of the lagging in the economy and pushback to the real estate market, we probably will see an average price of the first or second quarter of the 2021, which is still compared to the pre-pandemic is healthy and positive. Consumers, they have to keep in mind that the double digit of the growth was not sustainable. It was what we call it fraud or fake, and it wasn't healthy. Canadian real estate over the last of the 20 or 30 years had a continuation of the growth of the 7 to 8% on annual growth. We suddenly had 30, 40% from 1 month to another month. But if you take it an average of the 12-month cycle, we are now still in a double digit. It could be lower double digit, 10 to 12%. And I don't see it will be lower than that. So if you do a comparable, do on a third quarter of the 2021 investment.
That's all for questions, Steve. I'll let you wrap it up.
Thank you very much, everyone. I want the last comment that I would like to take on, and then I pass it to Derek for his final comment, would be if you take a look at the cycle of our business, the price of the home for detached home or freehold home that we call it in our industry went through the roof. And then we noticed that segment become unaffordable. So obviously the most affordable segment was condo market or townhouses or semis and the suburb. We saw that segment went up. And now we notice that the rental market is becoming really now unaffordable. And there is right now, if you sit down and talk, even if with the high interest rate that we have in the market, there are the market center within Ontario that buying is better than the renting. So this cycle has happened for years in Canadian real estate market and will continue to happen. So it's a sort of a moderation cycle right now. We want to pull back the prices. We want to make them sort of an affordable period for probably a short period of the time. But the long-term issue will be the supply. And as Derek also alluded in his talk this morning, I don't think so. Neither of us, we think that the supply issue is going to be resolved, at least while I'm around. Maybe the next generation can see it and enjoy it. Derek, I leave the last comment to you.
Yeah, I do see that. I'm fully on board. I think the way I characterize what we're seeing now is just we had that volcanic increase in pricing and sales during the pandemic. What we're seeing now is an unwind of a good chunk of that. What gets us thinking this isn't going to be something much, much worse is some of these underlying supports, the job market, high level of excess demand for employment, a good cushion, excess savings of households. I know a lot of focus on high debt, but looking at deposit data, there's a big chunk of savings that remains in the Canadian economy that can be used to fund these higher costs and higher interest rates, and an economy that's proved resilient. So I think we'll get over the hump. And then you get into some of the longer term support. Steve mentioned population growth. I think we will get back to some of these other challenges once we get through the some of the worries about downside on demand right now. It'll be kind of a redux back to maybe not the early stages of the pandemic, because that was unhealthy, but maybe going back to kind of 2015, 16, where we just were dealing with a market that was strong and that we needed more supply.
Thank you, Derek. Really enjoyed your insight. And thank you, our audience that tune in. We look forward to have you in the near future again in one of our episodes. Have a wonderful day.